Welcome to my economics channel, where I love discussing the subject, but most importantly, I love to make something fun and interesting to learn. And to that end, today I want to discuss exactly how the Federal Reserve and other central banks around the world are raising rates. More specifically, the mechanics behind the process. Now, in fact, I've actually previously made a video about this on my channel, but that video turned out to be rubbish, and no one should be watching that. So it's since been deleted, and this is going to be the much better version. And to that end, I've actually got 3 papers, which I'm going to be drawing upon for this video. The first one is a long one, Examining Modern Money Creation, an institution-centered explanation and visualization of the credit theory of money and some reflections of its significance. Then we have an older one, which was so thick that I actually couldn't staple it, Monetary Policy and Bank Lending. And then finally, the role of banks, non-banks, and the central bank in the money creation process. Now, the reason I bring these up is that the process is surprisingly simple on the one hand, but also surprisingly complex on the other. And one reason for that is that we have different terms for money, high-powered money reserves, and then bank money, sight deposits, and credit on the other hand. And also the fact that bank lending on the one hand and interest rates on the other are intimately linked, even though this is not immediately obvious. So on the one hand, we have the central bank, and then we have the banking system, and we have what I mentioned before. We have reserves, we also have what's called high-powered money, and then we also just have money, and then we also have what's called base money, or M0. These are all different terms, but referring to the same thing, which is one thing which makes the whole thing so complex, and I think unnecessarily so. But we'll just call them reserves to make it easier. And the idea is that the central bank controls the amount of reserves, and these reserves are what banks need to settle with each other at the end of every single day, or more likely multiple times throughout the day. So at the end of the day, one bank might need to borrow reserves from another bank, and another bank might have surplus reserves at which it can lend out. And in fact, this is where we get our market rate of interest from. The rate at which banks lend to one another, that is the overnight interest rate, or simply the market rate of interest. On the other hand, we still have banks in the middle, and then out here we have you and I, or everyone else. And we use money for all of our payments and everything else that we use money for. But more specifically, or technically, I guess, they're either called sight deposits, bank deposits, or simply credit. And this is used to differentiate the two monies, I guess you would call them. And from here on in, we'll just call it credit that you and I use. And ultimately, all of this new credit out here was once created by one bank in the banking system. When a bank creates a new loan, it creates new credit that you and I use. And the point being that when that bank creates that new loan, it has a bunch of criteria it uses to create that new loan to you and I, but it doesn't have to wait for deposits to come in first. It can create that new loan, that new credit, and then later on find those reserves, because it can borrow those reserves from another bank in the banking system. And that ultimately is the point of the interbank market, that banks are constantly borrowing from one another. And that ultimately, like I said, is what creates the market rate of interest. However, this process seems to create credit out of thin air. And it sort of seems like banks can sort of do what they want, and there's sort of no end to the credit creation process. However, this is not the case. If a bank creates, let's say, a $30,000 loan, and that's $30,000 of new credit, which is created out in the economy that you and I are going to use for payments or for whatever else that we're going to use the money for, that credit has to be backed by reserves. If the bank only has, let's say, $15,000 of reserves already, and it creates this $30,000 loan, it has to find $15,000 worth of reserves. If by the end of the day, it is still short $15,000 worth of reserves, it then needs to borrow those from another bank. If for whatever reason a bank cannot borrow from another bank, it can then go to the central bank and borrow those reserves. And so there are, of course, other factors that prevent banks from creating new credit, but this will be the most important one that I'm highlighting in this video. So on the one hand, there's demand for new credit out here based on the interest rate, but on the other, depending on the interest rate that the central bank thinks is right for the economy, this is also going to incentivize or disincentivize banks to create loans in the first place. Now, the point here is that there's an active market in the interbank market on a day-to-day basis for reserves. And there are always going to be surplus banks on the one hand, and there are always going to be deficit banks on the other. Now, like I mentioned, that is a market rate of interest that banks borrow from one another. But this market rate of interest is influenced by the central bank. And more specifically, we have a corridor system. We have one rate at which banks can lend to the central bank, and this is a very low rate. Until recently, this was 0.25%. And so if a bank had excess reserves, it could lend to the central bank at, let's say, 0.25%. And on the other hand, you can borrow from the central bank at a really high rate. I know, just for the sake of example, let's say it's 1.25%. The point being that the market rate tends to be in between these two rates. And the point being that banks negotiate the interest rate, the overnight rate of interest, with one another. And so that's why it settles in the middle. If one bank is trying to play hardball with its reserves because it's got excess reserves and it wants to get the maximum interest rate for those reserves with another bank, it could be that the very next day or the very next week, that same bank could then become a deficit bank and then it has to borrow reserves from another bank. And so these are correspondent banks, they trust one another, and that is why for a long time, the interest rate, the market rate of interest, the overnight interest rate, stayed in between the two rates administered by the Federal Reserve or indeed any central bank. And so what the central bank does is that it controls the amount of reserves in the system so that we have the right mix of surplus banks on the one hand and deficit banks on the other. If the central bank feels like there's too many surplus banks in the system for its given interest rate, it might hoover up, it might take some of those reserves away because that's what it can do. On the other hand, if there are too many deficit banks, the central bank might add reserves to the system to maintain that rate of interest. And this is why I was saying at the start of the video that the real story behind how the central bank or the Federal Reserve sets interest rates and indeed raises them is much more interesting than simply, choosing a new interest rate and pressing enter. And so more specifically, when the central bank wants to raise interest rates, it raises its corridor system. If the deposit rate or the rate at which banks can lend to the central bank is, let's say, 0.25%, the central bank or the Federal Reserve might raise that to 1%. And if the rate at which banks could borrow from the central bank was 1%, it might now become 2%. And the market rate of interest will once again settle in between. And indeed, empirically, this is what we see, that the federal funds rate effective is almost perfectly in between those two interest rates, the corridor rate of interest. And so now, following on from this, with this new higher interest rate, banks now have to pass on those new higher interest rates to you and I. And then that influences our decisions with whether or not to take out certain loans or what terms we're going to get those loans on. And it might be that a higher interest rate discourages people from taking out new loans, new credit, and so new credit is not created, and we can rein in the credit creation process. And that indeed is what we're finding with economies around the world. Interest rates are going up, and the credit growth in the economy is indeed slowing down. You and I, we're taking out fewer loans because of the higher rate of interest. And so, like I promised, that is how the Federal Reserve, or indeed any central bank, is able to raise interest rates. However, before we go, you will have noticed something. I mentioned there were deficit banks and there were surplus banks, and that there was an active interbank market, and that is how we get our market rate of interest, our overnight rate of interest. However, ever since 2007, now every bank is a surplus bank. There are trillions of dollars of reserves, and especially since the COVID stimulus, there are even more trillions of reserves in the system. Before 2007, there were about $50 billion worth of reserves in the system, and this was enough to settle every transaction in the US. No matter how much GDP grew, no matter what happened in the US, $50 billion worth of reserves was enough to cover every single transaction. And now there's about $10 trillion worth of reserves in the system between the central bank and the banking system. So the question is, doesn't that mean that the central bank loses control of interest rates? How can the central bank now raise interest rates and not lower the amount of reserves in the system? And so in fact, that's what I'm going to show in my next video. I'm going to show how the central bank can independently raise interest rates, but also keep the amount of reserves in the system at elevated levels in the many trillions. But that's the end of this video. Thank you for watching. If you have any questions, don't hesitate to ask down below and I'll do my best to answer, or I'll collect the questions in a follow-up video and I'll answer them there. If you wouldn't mind subscribing to my channel and also sharing my videos so I can reach a wider audience and eventually make money from my channel. which I guess in a third-hand sense will make you feel good as well. But thank you for watching all the way to the end of my video, and I hope to see you guys next time.